Welcome to this Iron Financial Explainer. Look, we're here to help you forge a stronger portfolio, cut right through the market weakness, and find the actual structural integrity in the raw numbers. I'm your lead analyst, and today we're looking at a company that is either building an absolute impenetrable fortress of cash flow, or they're laying a massive foundation on financial quicksand. We're breaking down SHAK's latest Q1 2026 earnings print, and right now, the market is completely split on this stock. Institutional capital is desperately trying to figure out if this massive upfront spending we're seeing is simply the cost of empire building, or if the underlying unit economics are quietly buckling under the pressure.
And I'm the market skeptic. Look, I'm here to ask the hard questions that you're sitting at home thinking about right now. Is this all just hype or is it real? Because on the surface, SHAK is an incredibly beloved brand. You walk past one in the city and people are waiting in literally massive lines for these burgers. But, as we all know, a great burger absolutely does not automatically mean a great stock. Today, we're putting their entire balance sheet under the microscope to see if this steal actually holds up to the narrative.
Exactly. We're going to strip away all the slick consumer marketing, all the branding, and look strictly at the raw, heavy-duty unit economics. Let's get into it.
Okay, let's dive straight into the central paradox here, because this exact scenario is what keeps retail investors up at night in cold sweats. You look at their 2025 fiscal year, and it was an absolute blockbuster by every traditional measure you could possibly want. They delivered a record $1.45 billion in total revenue. That's billion with a B. They just printed their 21st consecutive quarter of same-Shack sales growth. Unheard of, right? Yet, we look at the first quarter of 2026, and they somehow yield a net loss of $300,000. Record sales, massive lines out the door, but the bottom line is actively bleeding cash. How does that even happen? Identifying whether a cash bleed like this is just a temporary necessary investment or a fatal value trap is arguably the absolute hardest part of value investing. For your portfolio, a misdiagnosis right here, it means you're catching a falling knife. You hit the nail on the head. That is the multi-million-dollar question we have to answer. To understand this Q1 cash burn, we actually have to look at the concrete they poured last year. You simply don't build an empire without massive upfront capital. So before we panic, let's step back and look at the foundation they've laid.
All right, moving into Section 1, Forging the 2025 Foundation.
Before we go in and stress test the current quarter, we absolutely have to establish the structural integrity of SHAK's previous fiscal year. The massive, undeniable momentum they generated there is exactly what's dictating their heavy spending right now. It's like I always say, you don't pour concrete for a 70-story skyscraper without knowing for an absolute fact that the ground can hold it. The top-line strength we saw in 2025 was truly massive. This is a company operating with intense, built-in consumer demand. We saw a 15.4% revenue explosion, climbing from roughly $1.25 billion in 2024 all the way up to $1.45 billion.
Sure, I see the numbers, but any seasoned trader watching this knows that top-line revenue can be totally artificially inflated by just, aggressively hiking menu prices. Pretty much every fast casual chain on the market is pulling that exact lever right now just to combat inflation. They charge $1 more for a meal, the revenue looks like it goes up, but actual foot traffic drops. So are they actually expanding the physical business, or just charging a massive premium for a side of fries to mask a shrinking customer base?
That is the exact metric you have to verify. You're right. But the system-wide sales growth answers that clearly for us. It was up 15.9% to hit $2.23 billion for the full year. So no, they aren't just squeezing their existing customer base for higher tickets. They are literally opening new doors, heavily expanding their geographic footprint and driving serious, sustainable volume through those brand new locations.
Now, management is also doing some serious heavy lifting on the capital efficiency side, specifically driving a staggering 20% reduction in new Shack build costs. They've aggressively value-engineered their site designs. They've completely streamlined their procurement pipelines to bring the cost per new site under $2 million. Okay, I have to admit, as much of a skeptic as I am, that is a massive structural anomaly. Here is a really surprising fact for your portfolio context, folks. Across the broader restaurant industry right now, supply chain chaos and heavy material tariffs have actually made restaurant construction about 30% more expensive on average. So while the rest of the entire sector is paying a massive, painful premium just to break ground on a new spot, SHAK is somehow stripping 20% out of their construction costs. That fundamentally alters their return on invested capital. When you drastically lower the cost of entry, but you somehow maintain those famously high average unit volumes that SHAK is known for, the profit margins on those new locations are going to accelerate exponentially.
Exactly. Those capital efficiencies act as the rebar in their financial foundation. Let's look at how that operational discipline actually translates to hard profitability. In 2025, they achieved a 120 basis point expansion in restaurant-level margins, hitting 22.6%. But the real standout number here, the one you need to pay attention to, is the adjusted EBITDA. It spiked 19.5% to roughly $210 million. For those newer to the financial weeds, EBITDA is your earnings before interest, taxes, depreciation, and amortization. It's the purest, most unfiltered look at core operational cash flow. An almost 20% jump proves the core business model is an absolute cash-generating machine. And they leverage that strength to open a record 45 new company-operated Shacks alongside 40 licensed ones.
Okay, the 2025 blueprint was undeniably solid, I'll give them that. They scaled revenue, they magically slashed their build costs, and they pushed margins wider even while paying a premium for raw materials. But honestly, that just makes the Q1 2026 print even more jarring for investors to look at. Because if the foundation is supposedly built out of solid steel, why is the structure suddenly leaking cash everywhere?
This brings us to Section 2, Cracks in the Armor.
I'm stepping in here to violently stress test this Q1 2026 balance sheet because we need to aggressively hunt for where the structural weakness is hiding. This discrepancy is a glaring reality check for anyone riding the hype train. Top-line revenue for the first quarter jumped 14.3% year-over-year, hitting $366.7 million. It's a massive top-line number for sure, but the bottom line? It translates to a $300,000 net loss. I want you to really let the gravity of that sink in for a second. You bring in nearly $367 million in a single 3-month quarter, and you still somehow lose money. A year ago, in Q1 2025, they posted a $4.5 million net profit. So they are driving significantly more money through the front door, but the capital is just bleeding out the back. To me, this is the exact textbook profile of a company growing way too fast for its own good. We absolutely have to analyze the specific friction points causing this bleed. January weather was incredibly brutal, and management explicitly cited a 240 basis point drag on their comparable sales just from severe winter storms, literally keeping people trapped at home. Now look, Wall Street analysts always love to blame the weather when a quarter misses expectations. It's the oldest excuse in the book. But in this specific case, the localized geographic data actually backs it up. On top of that, aggressive beef inflation is putting high single-digit pressure directly on their core commodity costs. It is a really tough macro environment out there right now. There's no denying that. But for your portfolio, you have to realize that in the current service sector, positive foot traffic is the ultimate unbreakable competitive moat. Traffic for Shake Shack was actually up 1.4%. That makes this their third consecutive quarter of positive traffic. Think about that context. Right now, almost every single major fast casual and quick service competitor is reporting negative foot traffic. The everyday consumer is financially exhausted and pulling back hard. The fact that Shake Shack is still grinding out a 1.4% gain in physical human beings deciding to walk through the door and spend money is a massive testament to the durability of this brand.
All right, I'll concede the traffic point. It's impressive. But traffic doesn't pay the bills if your profitability totally collapses. Adjusted EBITDA dropped 9.3% year-over-year, falling all the way down to $37 million. That means their EBITDA margin shrank to just 10.1% of total revenue. And the culprit here? Heavy spending on general and administrative expenses. The dreaded G&A load.
For the investors watching at home, we need to clarify this. G&A isn't the cost of making a burger or paying the line cook, it's the corporate overhead. It's the regional management teams, the massive enterprise tech stacks they're building, the hefty pre-opening costs for unbuilt locations, and yes, the executive salaries required to actually manage a growing global footprint.
Exactly. It's corporate bloat versus expansion infrastructure. When a company rapidly scales its corporate offices anticipating future revenue that hasn't arrived yet, they create a highly dangerous scenario. If consumer spending suddenly slips even a little bit, that massive G&A would remain completely fixed. You can't just unhire a regional vice president on a Tuesday because beef prices went up. My fear here is that this aggressive growth has simply become far too expensive to sustain organically.
Let's transition to Section 3, Supply Chain Heavy Lifting. Here is where we actually see an incredible operational defense mechanism at play. While the corporate level is spending heavily on infrastructure and new store builds like you mentioned, the actual physical restaurants are fighting off inflation with absolute bare-knuckle efficiency. And it starts fundamentally with the product. Shake Shack actively leverages culinary innovation to drive sales up without blindly raising baseline menu prices. For instance, they rolled out a smoky barbecue menu anchored by a boneless baby back rib sandwich. Okay, I have to say, this is actually a brilliant psychological play on the consumer. If you hike the price of a standard, everyday cheeseburger by $2, consumers will actively revolt. They know exactly what a basic burger should cost. But if you introduce a premium, limited edition item that they can't price compare, you have total unchecked pricing power. Exactly right. Consumers will happily pay a premium, but only if you give them a premium, innovative product in exchange. That targeted, smart innovation directly fueled their 4.6% same Shack sales growth in Q1, protecting the top line without alienating their core loyal base.
But here is the real structural triumph that blew me away. They're facing high single-digit beef inflation. In the premium burger business, beef is quite literally everything. It makes up roughly 30% of their blended food and paper costs. When your core structural commodity spikes nearly 10%, traditional restaurant economics dictate that your margins will get absolutely crushed into dust. There's no way around it. But Shake Shack? They actually expanded Q1 restaurant-level profit margins by 50 basis points to 21.2%.
That literally defies financial gravity. How do you pay almost 10% more for your central core ingredient and still manage to widen your profit margins at the actual store level? It doesn't make sense.
You do it by relentlessly reinforcing your supply chain pillars. They completely accelerated their long-term cost-saving initiatives. They aggressively diversified their supplier base to force competitive pricing, they renegotiated incredibly complex freight logistics, and they used their sheer growing scale to demand better raw material costs elsewhere to entirely offset those beef spikes. It's heavy lifting at its finest.
And they paired that massive supply chain muscle with severe labor productivity optimization. They rolled out incredibly stringent performance scorecards across their Shacks. Attainment to their labor guides jumped from 50% in mid-2024 to over 90%. Average wait times dropped to under 6 minutes. But the absolute most vital metric here, the one that guarantees stability, is that team member tenure increased by 40%. For anyone out there evaluating a service sector stock, listen to me very closely right now. Employee turnover is a massive, hidden tax that will literally bleed a balance sheet dry before you even know what hit you. The standard cost to recruit, onboard, and train a single new fast casual employee is routinely estimated at over $2,000. Plus, high turnover leads to operational mistakes, wasted food, and painfully slower service. By keeping their crew 40% longer, Shake Shack is literally saving millions in invisible costs. Tenure is a leading indicator of margin stability. It is a massive structural defense against the inflationary pressures they are currently facing.
Let's move to Section 4, Blueprint for the Future.
So we've established the store-level unit economics are highly profitable and running incredibly lean. The cash burn we are seeing is clearly happening at the corporate level to build out the network. So we need to see if this long-term blueprint actually justifies the short-term cash burn. And management, they are absolutely not backing down. They are putting their foot entirely on the gas. They increased their 2026 guidance, aggressively targeting 60 to 65 new company-operated Shacks, plus another 40 to 45 licensed ones. They are also sinking massive capital right now into a digital expansion via Project Catalyst, building out a premium loyalty app to intentionally drive customer frequency. Market skeptic. Look, we have to address the elephant in the room here, that massive general and administrative expense load. Management fully admits it will remain incredibly heavy throughout 2026. Their only defense is a promise that by 2027 they will achieve true G&A leverage, meaning their sales volume will finally start growing significantly faster than their corporate overhead. As the market skeptic here, I have to call a timeout. Promising leverage 2 years from now is a classic Wall Street delay tactic. It's asking retail investors to subsidize massive corporate spending today on the mere hope of efficiency tomorrow. If that leverage does not mathematically materialize by 2027, this entire aggressive expansion model buckles under its own weight.
The risk is absolutely real. I won't deny that. But if they pull it off, the sheer scale of the resulting business is staggering. They are laying the scaffolding for a massive global operation, actively guiding for full year 2026 total revenue between $1.6 and $1.7 billion. Alongside that, they expect an adjusted EBITDA of $230 to $245 million. Sustaining a $1.7 billion top line requires an immense, complex operational footprint. The short-term pain, that Q1 net loss that spooked everyone, is essentially the necessary upfront cost of that aggressive construction. They are building a multi-billion-dollar global food empire, and frankly, empires require heavy, incredibly expensive infrastructure before they ever yield returns. Finally, Section 5, the verdict, opportunity or trap.
We've looked at the foundational wins, we've picked apart the quarterly cracks, and we've analyzed the aggressive future blueprints. Let's synthesize all this raw data.
The bull case here is forged in undeniable, deeply resilient structural growth. You have relentless top-line expansion, an incredibly rare 21 straight quarters of positive same-Shack sales, and they are miraculously maintaining positive foot traffic in a macroeconomic environment that is actively crushing their closest competitors. Furthermore, their unit economics are pristine. They slashed build costs by 20% and somehow widened store-level margins despite crippling beef inflation. The stores themselves, individually, are absolute cash-generating engines. But the bear case sees the rust creeping into the steel. You simply cannot ignore a Q1 net loss while revenue is simultaneously soaring into the hundreds of millions. The heavy G&A investments require immense, blind trust in a management team that is using a wait-until-2027 delay tactic for true leverage. Structurally, despite all their operational magic, they remain highly, dangerously vulnerable to volatile beef commodity cycles. If macroeconomic conditions worsen even slightly and consumer spending finally snaps, that massive, expensive corporate scaffolding they just finished building will suddenly become a suffocating liability.
So, we leave you with this final, crucial framework. As you monitor this stock moving forward, I want you to watch the next earnings print closely for two very specific metrics. 1, does foot traffic remain positive? And 2, does the G&A spending as a percentage of revenue actually begin to taper off? If the answer is yes, the empire is being built exactly as planned. If traffic dips while corporate costs rise, the foundation is cracking. Market skeptic.
Is the Q1 cash burn simply the necessary upfront costs of building a global empire, or is it a fatal flaw in a company growing far too fast for its own good? We've stress-tested the steel. Now you make the call for your own portfolio.
Thanks for joining us on this Iron Financial Explainer. Keep your analysis sharp, always trust the raw data over the corporate hype, and we'll see you next time as we break down the market's biggest moves.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.